Good morning. It's Friday the 13th, which sounds ominous. This is what is on today's agenda. The AI scare, that trade hits logistics. Affordability in focus again in the United States. And the Munich Security Council puts nuclear deterrent centre stage.
Asian markets, it seems, not immune, at least for now, to that AI fear then. And currently across the benchmark, down 1.3%, snapping 6 days of gains. European futures pointing to very modest gains of 0.1% after ending lower by about 0.5 yesterday, with tech once again alongside basic resources a drag. Gold in focus after dropping at one point yesterday by about 4%. Today up 0.8%, but still below $5,000 per troy ounce. The countdown to the opening trade starts right now.
Morning, how you doing? If you know what's going on, please let me know, because I'm pretty sure this market doesn't know what's going on right now. We've got to the point with the AI scare where we're selling logistics companies. Kuehne+Nagel got absolutely whacked yesterday. Where's next? What is going to be next on the list of things that get hit by this AI scare? This is a market that doesn't really have a handle on what is happening. That's scary in itself on Friday the 13th. By the way, stocks normally go up on Friday the 13th, which is kind of worth noting, just kind of to calm everybody down. But nobody knows what's going on.
A $6 million karaoke company, former karaoke company, now has an algorithm. But that is what created all of the latest scare in markets. It's only worth $6 million, or it was before this happened. It took way more than that off the logistics names that you talk about. And if we count the ways that we are concerned about AI right now, it's legal services, real estate, software, insurance brokerages, wealth management, financial analysis. The list goes on and on.
Keep going. The Russell 3000 trucking index, one of my favourite indexes, was down about 7% on the back of this news. This was a mic drop moment from Algorithm Holdings.
For them. Their CEO is very surprised.
It's another surprise CEO of a mini company.
How did we do that?
Company rocking in an entire sector with an update to some platform that could adjust logistics on the margins.
This market has no idea. We have we're now selling CRE companies, commercial real estate companies, because we're worried that actually, a bit like COVID, people won't be coming into the office because there won't be any jobs to come to in the office. So why do you need offices? You extend that thought. Why do you need aeroplanes? Why do you need holidays? Why do you need... you go on and on.
Yeah, absolutely. I mean, I was looking at BI did a presentation on the SaaSpocalypse and the AI scare trade yesterday, and they were calling this a manic market. And there is actually a definition that goes behind that, but it involved 6 different inputs, so I won't go into it. But it's a manic market, they describe. And their takeaway from it being a manic market is that risk appetite tends to moderate in the few months afterwards, because it feels we're a little bit lost right now.
I was at a tech event, just briefly. I was at a tech event last night, quite late. And I spoke to a founder there, and I said, how are you doing? He just said, wow, things are moving so quickly. He is in this space, and he is surprised by how quickly the innovation was changing. He was glued to his phone, updates after updates in terms of what's coming through from some of these tech companies, the AI companies, the large language models. He's glued to his screen. He is discombobulated by the change that's coming through. I spoke to a founder investor, and he said, actually, we don't think the markets and society have fully understood the impacts of this. But I was getting different views. They don't know, and they are at the cutting edge of this technology. They are also being whipsawed by the changes, by the innovation.
Society's worried about inflation right now. How do you think it's going to feel when actually there are no jobs? At the moment, we're worried about how much groceries cost. But there are still jobs. How are we going to feel when groceries cost this and there are no jobs? Inflation's quite a big deal still.
Inflation is a big deal. It's okay. I'm off to become a plumber or something. That's my career backup plan.
So this is the Financial Times on the inflation concerns now in the White House. The Financial Times reporting that they are planning in the White House to scale back some tariffs on steel and aluminium. And again, quoting from the Financial Times, the People said that trade officials in the Commerce Department and US Trade Representative's office believed the tariffs were hurting consumers by raising prices for goods such as pie tins and food and drink cans. If you put tariffs on aluminium and if you put tariffs on steel, guess what? It will end up impacting consumers at some point.
So that takes us to CPI a little bit later on. We're going to get inflation data out. Is this going to be the latest thing that kind of moves the market? Do I even care about economic data at this point when the AI story is moving in the way that it is and as fast as it is? But the inflation data, if we end up with... You would assume that if you have a solid jobs market, then plus tariffs, you probably end up with inflation. Is the risk to an upside? Yeah. How does the market react to an upside surprise today? Because yields have been coming down, not up.
Absolutely, and I think that's the interesting point, isn't it? That bonds have been acting as a bit of a haven. Treasuries have been acting as a bit of a haven through this AI scare trade. And so is that at risk, given what we might see on inflation? Because you get an inflation shock and that might all turn around. I was drawn to some comments by David Einhorn, thinking about how many rate cuts we get this year, which ties in with that inflation story, in the face of that inflation expectation. David Einhorn, hedge fund manager, talking about how the Fed is going to cut substantially more than the market is currently pricing in. And there are those views in the market that aren't so worried about inflation or don't think the Fed will be.
Why? But the Fed could also be cutting because the equity market just keeps going down, and you end up with a wealth effect, a negative wealth effect that impacts the top of the K, and that's something that will have a real kind of economic impact as well. So that's all. We have no idea what's going on in terms of AI, what's happening with the debt. We're also facing, obviously, a huge security issue.
Yeah, absolutely. And so we've got the Munich Security Conference taking place. Now, clearly, oil markets have been hanging on all kinds of geopolitical tensions, including war in Ukraine, but others as well. We've also seen defence stocks really rally on the back of, well, since the last Munich Security Conference, defence stocks have done incredibly well because J.D. Vance was, quite frankly, very scary to European leaders and the message he brought. He's not there this time. This time we get Rubio, which European leaders might be relieved about. But in terms of what we're going to be discussing here, there are two sort of contrasting things. On the one hand, you hear the organisers still talking about the importance of the transatlantic relationship, leaning into the transatlantic relationship. Maybe Rubio brings a different tone this time around. But on the other hand, you have conversations amongst Europeans about how you extend the French nuclear security umbrella to other parts of Europe. So Europe having to do more of its own security.
And this is reporting from Bloomberg that these conversations are taking place in terms of how to think about the nuclear deterrent for Europe if they have less conviction in terms of the support from the US. And it brings back the question in terms of the priorities for governments, in terms of how they spend and where they cut. If they are to fund not just increased defence spending, but maybe increased deterrence when it comes to the nuclear capabilities.
They're really expensive, which is why the UK outsourced its delivery mechanism to the United States, which again raises questions about the viability of that. People have asked all kinds of questions about that. I don't think anybody's actually got a clear answer. But again, in some ways, this comes back as well to what is happening with the AI story. Where are the jobs going to be? Are they going to be in the military? Are they going to be? Is this where kind of ultimately we end up with this kind of much more armed state with many more people employed by the military? You can kind of draw a line between one and the other and start to see maybe a future for it. Everything seems to be up in the air at the moment.
We may get some answers. Oliver Crook is on the ground for us at the Munich Security Conference starting today. Of course, we'll be getting interviews throughout our programme as well. And at 10 a.m. UK time, we're going to get Euro area GDP, so a pulse on the health of the Eurozone economy. 12 p.m. UK time, the BOA's chief economist, Hugh Pill, will be speaking after growth, of course, earlier this week for the UK disappointed. And at 1:30 p.m. UK time, we've touched on this US inflation data, of course, year on year expected to come in a little bit, 2.5% down from 2.6%.
There is a
tendency, to your point, do we get stronger inflation with a stronger jobs market?
There is a tendency also for the January numbers to be slightly punchier than you think, because people tend to raise prices at the beginning of the year, and the seasonality, maybe the seasonal models don't quite sort of take that into account. The other thing that's worth bearing in mind as well is that half the world's closed on Monday. The markets, financial markets. China's closed, Hong Kong's got a half day, the US is closed. So just in terms of the risk, how much risk do you want to take into a weekend, I think is another question that people will be asking.
Yes, often that weekend hanging over markets. Let's talk about a corporate news story this morning that has just been breaking across the Bloomberg terminal. And that is numbers from the bank here in the UK that is NatWest. Fourth quarter pre-tax operating profit coming in at 1.94 billion. That is nicely ahead of an estimate of 1.72 billion. So that looks good. They're giving some guidance on return on tangible equity as well out into 2028. So let's put all of this together and talk to Paul Thwaite, CEO of NatWest Group, who joins us now. Paul, very nice to have you with us. Let's start with this beat in the fourth quarter. So pre-tax operating profit, nicely ahead of the estimate. I wonder how sustainable that is and what's been going well for NatWest to deliver that beat.
Yeah, good morning. And yes, delighted to announce a really strong set of results today. Income is up 12%, operating profit is up 24%. We've also announced that our dividend per share is up 51%. on the year. So a really strong set of results. As you alluded to, we've also taken the opportunity to increase our ambition for targets out to 28. We've announced new targets today. Return on equity of greater than 18%, which moves our medium-term target from 15% to 18%. In terms of what sits behind those results, what you can see is we're growing our three businesses really well. So our retail business, our commercial and institutional business, and our private bank. Mm-hmm. Lending is up 5%, assets under management are up 20%. So it's a really broad set of drivers which is driving it up, and our cost-income ratio has also come down, as you can see from the results today.
Can I ask you about the ambition around return on tangible equity? You say greater than 18% in 2028. I think that some in the market actually had a 2026 ROTE target of 18%. You've come out with 17 today. Do you think the market will be pleased with the level of ambition here, or maybe slightly disappointed, Paul?
I think the market, we've come out with two sets of targets. I think the market will be pleased around the ambition for 28. We've also come out with a target of greater than 17% for 26. So to me, that shows our confidence in the trajectory and the momentum that we have.
Paul, good morning. It's Guy. You made some news earlier on this week with the Evelyn acquisition, the wealth manager. I'm wondering how you think about the valuation of wealth management assets going forward in a world where the market is looking at this and saying this is ripe for disruption with AI. Are you confident in the money you paid for that business will be durable?
Morning, Guy. I was delighted to announce the acquisition of Evelyn Partners on Monday. It's a leading financial planner and wealth manager. The combination with our Coutts and private bank creates the number one in the UK private banking and wealth manager. It's transformational for our wealth business. It brings scale, doubles the amount of assets under management we have, but it also builds a great set of capabilities, a direct-to-consumer platform, Best Invest, the largest employed financial advisor network in the UK. And that's why I'm confident that it positions us well for growth. I think it is a sector, as is banking, that is going to be transformed by AI and disrupted by AI. But we have strong conviction that the winning combination will be an AI-enabled wealth advice, but complemented by humans who can guide people through very complex financial decisions, inheritance planning, financial planning. All the research suggests that people want a hybrid combination, simple things digitally, supported by AI, but complex financial needs supported by humans. And I think the winners in this space are going to be those who have scale. And given we have 20 million customers across NatWest, we now complement that with Evelyn Partners. We think it positions us really well for growth.
Paul, just staying with the theme. Last couple of days, we've seen commercial real estate stocks get absolutely hammered. Again, the market is kind of asking questions that it doesn't know the answer to at the moment. So let me come to you. What's your exposure to CRE? Do you think CRE is vulnerable? Do you think the office market is vulnerable to the fact that maybe we won't need as many people in offices going forward?
Yeah. My personal view is I think there will always be demand for high-quality office accommodation. We've seen that over the course of the last couple of years. The quality demand has increased. We have a significant size commercial real estate book, so if we feel like we've got a good insight into that, it's less than 5% of our overall credit book, and actually it's performing really well. But what I think you'll see is a bifurcation. So there'll be demand for those really good city centre, high-quality offices, and maybe parts of the commercial real estate market will become a bit weaker over time. But net, I can't see a position where there isn't strong demand for good commercial real estate.
Paul, good morning. It's Tom alongside Guy and Anna. You talked about AI disrupting the banking space. What does that mean in terms of jobs? There's a lot of focus on this, a lot of interest, particularly graduates. Do you expect that NatWest will be hiring fewer graduates as you bed AI into the business?
Yeah, actually, this year we'll be hiring more graduates, Tom. Actually, the difference, though, is that the composition of the graduates that we're hiring has changed a lot. If you looked at the bank maybe 5 years ago and you look at the type of graduates recruiting now, we're recruiting into software engineer roles, data scientist roles, prompt engineer roles. So what we're seeing is not less graduates, but just a very different mix. We've lent into AI, we're embracing it. Our 60,000 colleagues are using the tools, whether that's for summarization, whether that's for coding and engineering. And I can only see that increasing over time. It's difficult to predict exactly what it's going to mean for the workforce. The one thing I am confident about is the workforce is going to look very different in 2 or 3 years than it does look at the moment.
OK. And you talked about 5% loan growth. What does that tell us about the health of the UK economy? We had GDP that disappointed earlier this week. Yeah. Are you seeing green shoots? And how do you see that impacting demand for loans going forward? Yeah,
it's a complex situation, I think both domestically and internationally. But I do think there are reasons for confidence around the UK. If you look at the macro picture, we're expecting 2 more 25 basis point rate cuts. We're expecting inflation to come down during the course of the year to its target level. As you say, GDP was a little bit soft, but we're still expecting growth next year. Unemployment, although it's ticked up, is still at absolutely low levels. So from my perspective, there are reasons for confidence. If you look at household and business balance sheets, they're actually on aggregate in quite good shape. Household savings have been high over the course of the last couple of years. Businesses have delevered over the course of 4 or 5 years. So they have the capacity to either spend or invest. And what they need is, I guess, is confidence around that in order to be able to make those decisions. So last year, we were cautiously optimistic and things played out well. We have reasons for confidence for this year.
OK. Paul, at the beginning of this week, things look very politically volatile here in the UK. They look a little calmer by Friday. But, you know, there's still room for plenty of change ahead, it would seem. What kind of message are you giving to the government? What would you like to see around the growth story in the UK?
Yeah, what businesses want, what financial services want. We want consistency, we want stability, and we want predictability. Why do we want those things? Because they're the conditions for growth. If we can drive growth, that's what raises living standards. So my ask, both privately and publicly, is to create those conditions. I spend a lot of time around the country talking to small businesses, big businesses, and it's those themes that come through: consistency, stability, certainty, because that will give everybody the confidence to invest for the future, whether it's hiring more people, whether it's investing in new machinery, whether it's exploring export markets. So my message is stability, consistency, predictability. That's what the country needs.
Paul, thank you very much. Paul Thwaite, the NatWest Group CEO. Thank you so much for joining us this morning. Coming up on the programme later, we'll check in on more European earnings, including L'Oreal, after the company's US ADRs posted their biggest daily drop since 2020, following a fourth quarter earnings miss. So the stage is set for weakness in Paris today. Plus, later this hour, we will take a look at how today's US CPI data could affect the Federal Reserve's next move. That conversation ahead with Ella Good, head of fixed income at BNY Investments. Newton. Up next on this programme, we check back in on the logistics trade. It was getting dragged into the AI scare trade, of course, and weighing on markets from the US to Asia. If you have questions, if you want to get involved in any of these conversations, please do reach out to us. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. Friday the 13th, 7:21 here in London. A little bit later than that over in Singapore, of course, which is where we find our executive editor for Asia Markets, Paul Dobson, who's with us this morning. Paul, good morning to you. Well, we have the latest iteration of the AI trade scare, don't we? It seems to be rolling from one sector to another. Before everybody in a white-collar job decides to go off and retrain as an electrician or a plumber, what can you tell us about the latest instalment?
It does sound like a good idea, doesn't it? If you become a person who's good at installing data centres, then you're going to be minted for the next few years, Anna. But, you know, as far as investments are concerned and what the stock market is doing, this latest event is kind of interesting because it's sort of come from nowhere. This company that used to be like a karaoke company reinvented itself as a logistics firm instead. And people are looking at the business model that it has and how it's using AI to allow for scalability at reduced costs, and thinking, well, this is one more area where AI can excel and can therefore do the job that other companies are doing at much more expensive levels, much more cheaply, and undercut them. I think there's a really good quote in the story, which is about this idea: the level of paranoia is category 5. So basically, people are looking at what is AI going to be able to do sometime soon? Which companies are vulnerable? Which ones are the ones with the high costs, high human kind of work hours, labor intensive, those kinds of things? Those are the models that are under pressure at the moment. And so that's where we're seeing that sort of, series of selling efforts coming in right across the market.
It imported karaoke machines. So it was tangentially in the logistics business. Bad for America, good for Asia. Is that the trade?
It's definitely one thing that we've been seeing playing out. I've been really interested in this, just how much the US market has underperformed this year, Guy. So the S&P went negative year to date yesterday in trading. In Asia, we're still up despite a setback today, more than 10% for the year to date. And part of that is this idea that Asia is at the top of the sort of supply chain when it comes to all of the AI infrastructure, equipment, chips. And some of the companies are doing extremely well as a result of that, not just the memory chip makers in South Korea, but also in Taiwan, TSMC, and the Japanese firms as well. And so that's leading to this big outperformance. But I think that there's more than that, because it's not just Asia, right? Over in Latin America, the market's up 20% this year. So it's more this idea that the rest of the world is outperforming the US quite considerably at the moment.
Paul, when I think chips now, I think inflation. We have CPI out of the US later today. How vulnerable are the markets to a higher print?
Yeah, so the Fed pricing has been wobbling around quite a lot at the moment, hasn't it? And the payrolls that we got earlier in the week, confusing us enough just because it was on a Wednesday, not a Friday, sort of had everybody pushing back again their forecast for when the Fed would begin cutting interest rates. If we get high inflation on top of that, then, people are going to be thinking, well, how on earth is Walsh going to be able to convince the FOMC to do those cuts that we decided to price in? And that could be bad news, not just for the bond market, but also for the stock market, for people who've been counting on the idea that the Fed is going to be lowering interest rates through the course of this year, based on the fact that we're going to have a new Fed chair that would lead the rest of the board to that decision.
Great stuff, Paul. Thanks very much indeed. Paul Dobson joining us out of Asia. MLIV Go is the function you need to know there. What else do you need to know this Friday morning? Goldman Sachs' top lawyer, Kathy Rumler, is leaving after documents released by the US Department of Justice showed her links to the sex offender Jeffrey Epstein. The CEO, David Solomon, says she will be, quote, missed. Rumler moved to Goldman Sachs in 2020, later becoming its legal chief. The bank says she had disclosed her dealing with Epstein's when she was hired. AMAT, Applied Materials, surging in late trading after delivering a surprisingly upbeat sales forecast, signalling the demand for AI and memory chips is fueling chip-making equipment purchases. The largest US supplier of chip-making gear expects revenue of approximately $7.65 billion in the fiscal second quarter. Applied Materials is bouncing back from a slowdown spurred by export restrictions on China, the biggest market for chips. Keep an eye on its European rival, ASML, at the open. And Anthropic has completed a $30 billion fundraise led by Singapore's sovereign wealth fund GIC and Coatue Management. The deal values the AI company at $380 billion, making it one of the world's most valuable private firms. Anthropic also confirmed plans to let employees sell shares at the same valuation, which is interesting when you think about the IPO prospect.
Yeah. By the way, that's more valuable than Disney, Netflix and Goldman Sachs.
Put together or just...
Not combined.
Right.
Not
just wondering how far we've
gone. But more valuable than Netflix, more valuable than Disney, more valuable than Goldman Sachs.
Does that, well, when you were talking about entertainment, I was wondering if that tells us where the new entertainment is.
I had to add Goldman Sachs in there.
Yeah.
I was trying to work out, so as you're saying that, I'm thinking, is the price of production of TV going to go down dramatically because of AI? I would have thought the answer would have to be yes. We're not going to have jobs, so we're going to need things to watch. So actually, I do wonder whether Netflix and Disney might become a little bit more valuable in society.
Yeah,
because we're going to need things to do.
Expansion as the cost of creation is reduced, but demand increases.
Yeah.
We need good things to watch.
Are you suggesting... No, I'm not going to go down that road.
Coming up, Ella Good from BNY Investments. Newton breaks down what we're seeing in the market. We'll focus on fixed income. Stay with us. This is Bloomberg.
Good morning. Friday the 13th of February. Don't let that scare you. 7:30 here in London. We are 30 minutes away from the start of cash equity trading, and the futures picture looks like this. A bit more scary, actually, in Paris, where we have competing moves, perhaps. L'Oreal looks negative. That could be the dominant theme. Capgemini maybe looks a little better. We'll talk about that later. The rest of the European equity markets, though, pointing a little higher, Guy.
US yields are going up. European yields are going down. We are waiting for CPI out of the United States. We saw a big drop down yesterday in yields, i.e. prices bid. This morning we're seeing a little bit of a follow-on trade, so yields are going down in Europe. So that's kind of the trade. But we're waiting for CPI, basically.
Yeah. On the tenterhooks, in terms of 2.5% could be the number. That is the forecast for CPI, which will break for you, of course. Let's bring in a market analysis and perspective on this right now. Bloomberg understanding that the Trump administration is planning, before we do that, we're going to get the tariff story, planning to scale back some tariffs on steel and aluminium goods. President Trump imposed tariffs of up to 50% last summer, but now officials fear higher prices are hurting consumers. Let's bring in our Washington Deputy Bureau Chief, Laura Davison. Laura, what do we know about this? How serious are they about rowing back on some of these tariffs, and how much of this is about angst leading up to the midterm elections in the US?
A lot of this is about angst. The White House and the trade teams are still working at exactly what these details are going to look like, but they're looking at rolling back, what was really a sweeping tariff plan on steel and aluminum, as well as component goods. So anything that had those metals in it, so things like appliances, electronics, food packaging. And the recognition here is that these are really, these tariffs are being passed on to consumers, and this is really starting to hurt voters, particularly as we're headed into a midterm election in the U.S. in November, where it's all about affordability and cost of living. We saw the administration do a similar move last summer when it came to different food products that can't be grown in the U.S., things like coffee and bananas, as a way to at least, pull back some of these tariffs. And it's an acknowledgement from the White House that perhaps some of these tariffs at least are passing on the cost to the consumers and raising prices for households.
OK, we'll see to what extent they wrote back some of those tariffs. Bloomberg Washington Deputy Bureau Chief Laura Davison. Laura, thank you very much indeed for that update. Treasury's pairing some of yesterday's gains, as Guy mentioned, as investors look forward to, or not, to US CPI data later today. Fed Governor Stephen Miron says monetary policy is still too tight.
It's still slack in the economy, increased potential output that can be accommodated by looser monetary policy. And so the combination of these things leads me to think that monetary policy is tighter than it needs to be, and that we can afford to have lower interest rates.
I'm still not clear if this is a Stephen Miron speaking to President Trump or a Stephen Miron speaking to some fundamental and counterintuitive economic analysis. But that is his view. Rates need to be lower. Let's bring in Ella Good right now, Head of Fixed Income at BNY Investments Newton. Ella, good morning.
Good morning.
The Trump administration seems to be worried about inflation. Should the markets be worried about inflation?
The risk is there. I mean, it's very difficult to know from the moving parts on, will we get productivity because of the implementation of this AI boom story? Or are we going to get the inflation coming through commodities? We just talked about precious metals and industrial metals. Everything's been going up quite a lot last year and this year. So which force wins? Plus, if you add tariffs from last year onto that, there's definitely a risk. So we're probably siding more with the risk is high that we get some inflation coming through. But of course, it's quite an uncertain backdrop, something we've never had to navigate before in markets.
Risks are high that some inflation comes through. How does that percolate through the Treasury curve then? How do you see... they are seeing to play something of a safe haven role right now,
right.
So that's a factor. But then there's the inflation risk.
Yes, I mean, I like to think in asymmetry. So I'm thinking, OK, so if inflation continues to be benign, that's more or less baked in the cake, if you like, in terms of pricing, because we still have a couple of cuts on the table. If it comes a little bit lower, sure, maybe we can price in a little bit more cuts. But when you look at where 5s and 10s are, certainly if we get a surprise on the upside, the move could be nastier. And so I think the asymmetry is there. Sorry?
How much price could 10s be? We're at 4.1 now. How close to 5 could we get if inflation comes back?
Pretty rapidly, I would say. I mean, it's not priced in markets right now. You don't see it in a lot of vectors.
Yeah.
But at the beginning of this year, we started to see it in inflation expectations, the shorter term stuff. And so that's probably worth watching. We'll see. I mean, I don't know if we're going to get that after today's data. I cannot, foresee exactly where the number comes. But, if you think down the line, asymmetry-wise, the risk is for higher, right? Because we have quite conducive policy, monetarily, fiscally, the economy is booming. I mean, you have pockets of weakness, but broadly speaking, things look good for now. So, yeah, definitely more risk that I think we get a skew to the upside.
What's the AI effect going to be in the credit markets? We're looking at it in the equity markets, and we're kind of seeing stocks all over the place at the moment, and people, like, it's logistics, it's CRE, right. It's kind of, how does that manifest itself in credit?
Well, we're seeing some of those soft spots in private markets. So private credit, where you have 20% of lending down to software, and we've obviously seen what's happened to software the last couple of months. So difficult to see that pressure alleviate. In public markets, we've seen a bit of a follow through, but everything seems to be okay. So I mean, I would argue more inflation. Obviously, if it pushes rates higher, it filters a little bit into credit, but not in the initial phases. Remember that particularly high yield tends to like a little bit of inflation, right? Because it's that nominal growth component. Later on, depends how much inflation we get and whether that actually features into a disruptive move in rates. So the risk, then you can see credit suffer on the back of that.
The risk to credit is on that side, the inflation side, rather than the AI taking some of these business models away.
Yeah, I mean, we're seeing some of that, absolutely, as I said, in the private market side. That can continue, and we're watching that because it is a tail risk, but it's a tail risk that can morph into something bigger. For now, it seems isolated to private markets, but it can always morph into public, of course.
Thinking about the Treasury market, Ella, I wanted to ask you about China. And, I mean, we've seen this interesting guidance come out beginning of this week, very recently. We seem to be aimed at the banks. It wasn't necessarily reflecting the sort of sovereign stance of China wanting to reduce Treasury holdings. But China has been reducing Treasury holdings over the last decade, hasn't it? I mean, how are you interpreting the signals from China as to the role they want to play in treasuries, and does that matter to the extent it used to?
I mean, it's a long-standing trend. I don't think it matters for the next quarters, but perhaps for the longer term. And the biggest trend that I've taken away from that is what it means for precious metals, right? So that's been in our radar, and we've owned it in our multi-asset portfolios for a good couple of years. I think that trend remains in place because there is diversification away from treasuries, and I think there's plenty of supply to come. So you will see a transition from your traditional buyers, your reserve managers, into perhaps more of a public market, potentially more in the U.S. So that's the transition that we're seeing, and I think that probably will continue to play out.
So even though we saw jitters in gold and precious metals yesterday as people sold it, reportedly to cover margin calls on stocks, but hard to say, that you could kind of see that coming because it's very liquid, the gold market, but you still think the fundamentals mean that gold goes higher from here?
Structurally, yes. I think we can get over the short-term correction, potentially even as low as 4,000. But I think on a structural basis, the demand is there. And there's a lot of uncertainty, as we said, right, in terms of what the future holds. Quite big geopolitical winds happening at the same time. So for a lot of investors, it's something that they don't own enough of, right, if you think about high net worth individuals, etc. So it is something that has a place in a portfolio, we think. I mean, it's not going to be your core component of your portfolio, but that should probably override some of the shorter-term dislocations that we see.
Thinking of gold, I saw 4 states in the US now. Well, 2 of them have already decided, and 2 are about to decide to accept gold as legal tender. I mean, I'm not quite sure how that exactly works.
Are we going back to the gold standard?
Well, but maybe. I mean, it's got echoes, hasn't it? But I mean, the Bank of England has less gold than it used to, but it still has a lot.
Thanks, Gordon.
Yeah, and central banks have been buying a lot of it. Thank you, Gordon Brown, for that. Ella, on the UK then, we've been talking about the election risk in the US, the midterms in November. Do we need to start to price in an additional risk premium to UK gilts in the lead up to May and local elections and the potential fate of the Prime Minister?
I mean, the funny thing is that gilts have quite a bit of premium to them if you compare them to other G10 markets. So the curve is very steep. Your premium over and above inflation, particularly the rolling 2-year inflation, is pretty high. So you would argue, should they have more? I mean, we are, as Mark Carney said, reliant on the kindness of strangers. So, of course, the bar is that much higher for gilt in that sense. But there is some political premium to them.
How much of a blowout do we get if there is a challenge after May?
I mean, I wouldn't call it a blow-up. I mean, actually, I think for us, they represent value, particularly relative to treasuries, because, treasuries are pricing quite a bit of good news in our view, and, gilts are pricing.
You buy gilts?
We like owning some gilts here, yes. And that's because the expression is that there's a lot of premium priced into the curve. But, of course, we are cognizant that you can have more nervousness leading into May. I mean, Bank of England spoke overnight, right, in terms of the rate cuts probably are underpriced. I think that's a fair assessment. So hopefully the markets will give the leeway for those cuts to come through.
Nice to see you. Thanks for stopping by to see us. We always appreciate it. Ella Gooder, the head of fixed income at BNY Investments Newsom. Thank you very much indeed. Coming up, we're going to go to Munich. Security Conference is on. Ollie Crook is there. Kongsberg Defence and Aerospace President is going to be joining him shortly. That conversation coming up. This is Bloomberg.
Welcome back. UK Defence Secretary John Healey says allies have pledged as much as $35 billion in new military aid to Ukraine to strengthen its air defences. That's after a series of Russian airstrikes on energy infrastructure and civilian targets. It comes ahead of the Munich Security Conference, which starts today. Let's bring in our chief European correspondent, Oliver Crook, who is on the ground for us in Munich. Ollie.
Yeah, that's right, Tom. We're here in Munich, which we remember really kicked off the sort of MAGA foreign diplomacy 12 months ago when we had that speech from J.D. Vance. This has really reordered many things in Europe, particularly in the defense sector. So I'm very pleased to be joined by the CEO of one of the majors in that sector, Eirik Lie, who is the CEO of Kongsberg Defense, soon to be CEO of Kongsberg Group. Thank you very much for joining us today. I'd like to just it's been such an active year, but I really want to have an understanding from you over the last sort of month or so, since the so-called Greenland moment here. There's been a lot of concern about European countries having sovereign capabilities. Have you seen that sort of translated into your order books? What kind of conversations have you had in the last few weeks? Have you felt a sort of shift in the tone?
Well, if I take one step back, I think it's important to realize that last year we focused on two major items. One is to win the Ukraine war, and the other is to rebuild or build up even more in Europe. And I think those two elements still are there. So we focused on that Ukraine needs to be helped to be supported to win the war. At the same time, Europe needs to continue the build-up of the capacity. And I think that is our focus.
And so the build-up in capacity, we talk a lot about the gaps in capacities, but also wanting to buy European, right? This is a very active discussion within Europe. Do you see that there are certain gaps within the market? Obviously there are, that you as Kongsberg could fill. What are those? What are those going to be in the next couple of months and years?
You know, our company is very important. It's very important for us to be both in Europe and also in US and other places in the world. And we see that trend that there is some more European content that fits us very well. At the same time, we will leverage what we are doing in the US to build up more capacity there. So we are building up capacity and other technologies, both in the US and also in Europe, and that fits our business model very well.
And then when we think about the kinds of hardware and the kinds of things that people are showing demand for, obviously you're involved in the JSMs and sort of key missiles for the F-35s and things like that. Where is most of the demand coming in the last couple of months?
Well, I would say that we still see a high demand for air defense and our strike missile capacity. That will still be relevant for many years. At the same time, also in the counter-US, anti-drone systems, we get quite an important contract in Poland just a couple of weeks ago, which is paving the way forward for the counter-US segment. At the same time, you'll see also the space segment and also the underwater domain segment as the new two frontiers.
So I want to drill down into a few of those. So obviously you're market leaders in the sort of mid-range air defense systems, short-air defense system. We talk a lot about in Europe the sort of absence of being able to really match the Patriot system that the United States has for those long-range missiles. That is, of course, what Ukraine needs critically. Are you going to move into that space? Is there a timeline, do you think, that you'd be able to bring something to market that really competes at that level?
So currently we are working on expanding NASAMS. Yes, you're right. It's in the medium range, and we have the counter-US capacity. We want to expand NASAMS to be a full-spectrum air defense system. That means we need the longer-range capacity as well. So the technology in NASAMS and the architecture, which is open, is to embed and include other missiles to really be an anti-TBM system as well.
Mm-hmm. And then the other sort of one of the main issues, I think, that for Europeans and thinking about the sort of gaps that they have in their systems, there's a way in which the United States may have something close to a sort of monopoly on space. You have SpaceX and all of these sort of companies within the U.S. You're also involved in that space. What do you want your role to be in space?
I think we cover the whole full chain delivery of space activities. We are Europe's leading provider of satellite platforms on the small satellite segment. At the same time, we have KSAT, which is the world leader of taking down data from all satellites. And this combination is quite unique. So we see Kongsberg in a role taking a leading position for this new space segment, also for military purposes.
And I think that we've also learned that basically your defense is only as secure as your supply chains are. I spoke to the Rheinmetall CEO. He has a meeting every single week about rare earth metals to make sure they have the supply. I'd like you to sort of describe for us kind of where we are on these sort of memory chips, rare earths, how concerning that is to you, and sort of how much runway you have in terms of stockpile and how you think about that issue.
Yeah, this is very important for us, obviously, for all companies.
Yeah.
So we are concentrated on our supply chain to secure that we have the capacity, and we are building up what we call a buffer strategy, so that we have months so we can support our own production. Mm-hmm. And that is what we are discussing with all the different suppliers we have in our supply chain.
And are you, for example, Rheinmetall said that they have 12 months of supply. Is that the kind of window that you guys have, the runway you have?
Yeah, we look at the year window, but it depends on what systems we are talking about.
And I'd like to also get, because you're also reshaping the business, splitting off the maritime unit, also then doubling down on defense and civilian. Thinking more broadly about the structure of Kongsberg going forward and the possibility for M&A. What sort of sectors are you looking to make acquisitions in? Where would you like to see that sort of bouquet of sort of companies and capacities expanded?
Yeah. You're correct. So Kongsberg Group is demerging Kongsberg Maritime as a new listed company, and then the existing Kongsberg Group will be a more focused defense company with civilian technology included. So that's our main aim with the new direction we take. At the same time, we see that, if you look at our order backlog, our priority number one is to deliver on our promises. Mm-hmm. At the same time, we want to continue the innovation path we are on. We need to accelerate what we are doing, and that also includes M&A more actively.
And then, so obviously you mentioned the backlog there. Something that's connected to that would be how much demand there is, the sort of margin. So I was looking back at your margins in the fourth quarter back in 2020. It was about 13%, now almost at 21%. Obviously very good news for you, but potentially concerning to some governments who are spending basically taxpayer money to buy all of this equipment. How do you sort of balance that, the need to sort of obviously continue to be profitable, to reinvest, but also be able to spend that money sort of responsibly and not have that sort of pressure from governments?
This is very important for us as well. We as a company, we like to do investments to build up capacity, to do R&D in order to support the customers around the world. And I think this is what we have done. We have invested in factories and built up capacity in the US. We are doing currently the same in Europe. And we are also building up factories in Australia, as an example. So I think this is what we will continue to be active in investments that will help also the governments around.
Well, Eirik Lie, thank you so much for your time today. We're kicking off really our coverage here at the Munich Security Conference. That is the CEO of Kongsberg Defence and the incoming CEO of Kongsberg Group after that demerger of the maritime unit.
Ollie, thank you very much. Bloomberg's Oliver Crook on the ground for us at the Munich Security Conference. Let's take a look at some of the stocks we're watching this morning. Just 10 minutes until the start of cash equities trading. Louise Moon has a preview of some of the sectors and stocks that could be on the move. Good morning, Louise.
Good morning, Anna. First up, we are looking at miners, a key sector in focus today. This is after a report that Donald Trump is weighing up whether to pull back on some of the tariffs surrounding aluminium and steel. He imposed 50% tariffs last summer, potentially might pull back on some of those. So we're looking at miners that are likely to be impacted from this. They've had a strong year so far, the likes of Glencore, Rio Tinto, the usual suspects. So you would expect this to kind of boost their share price again this morning. I mean, this is all to do with concerns from Trump over raising costs on consumers. There's also a bit there to do with his approval rating. So potentially pulling back on some of those tariffs, and we'll be watching those miners in focus today. The other sector we're looking at is also logistics across Europe. Logistics companies, the likes of DSV and others. There's fears here over a bit of a disruption from AI, kind of the latest sector to get embroiled in these AI disruptions. This is all because of a company in the US, a very small company, actually used to be a karaoke company, now an AI firm. They're fueling concerns that this could really disrupt logistics. So we're looking at DHL, DSV and others. Their stock was hit a bit last night, late in trading. This is on this news. US peers then tumbled, so it's a bit of a day two story. Some analysts are saying, worries could be a bit overstated, but so we'll be keeping an eye on how they do at open. And then finally, the last one we're focusing on is just one company, Capgemini, the French IT firm. Also, they've had a bit of a rough year, down over 46%. Also to do with AI worries, a pullback in spending. They had fourth quarter results mostly in line, but the key thing people are really focusing on is comments by their CEO saying that going forward, AI is really going to be their focus, and that's going to fuel sales. So some glimmers of light, a bit of hope, so you'd expect the stock to rise into the green.
OK, Louise, thank you very much. Louise Moon with some of those stocks that could be on the move. And I was taken by, there are actually parallels between what we were hearing about the Munich Security Conference and what we heard from Capgemini, because both of them are sovereignty stories, at least in part for Capgemini, because they're citing, there's lots more AI work for them to do, and part of that, and then there's also the sovereignty piece, and the more countries want sovereignty, the more work there is for IT companies such as Capgemini, and obviously sovereignty is very much part of the agenda in Munich.
Yeah. Maybe AI does it, though, rather than software companies doing it. I don't know. It's going to be interesting to watch. We don't know. That's the problem, is and how long it takes for some of this AI technology, and they talk very much about it in their statement. How long can they incorporate it faster than somebody else can disrupt them, I guess is the question.
And on the sovereignty piece, they've paired and partnered with companies like Mistral, which is essentially Europe's best bet at large language models to kind of try to rival the likes of OpenAI and Anthropic, which very much is focused on the sovereignty story. ASML's an investor in Mistral. Capgemini is working with them as well, and they're building out their own infrastructure and data centres.
I'm really interested in the way that the market is putting a positive take on Capgemini this morning, because there were things about organic free cash flow you could have focused on for the full year and taken away a negative message. But no, that's not the mood the market's in. But they are in a negative mood around L'Oreal. Those shares look as if they will
the question seems to be North Asia, and analysts looking for the details there. It's very competitive, increasingly competitive in China, but also a lack of travel, it seems. The restrictions on Chinese travel to Japan may be an impact as well. So that seems to be the focus.
Keep an eye on DraftKings and the ripple effect into Europe, the prediction market. The outlook from DraftKings was weak. Keep an eye on Flutter. That could be a trade you want to watch out for this morning. 5 minutes ago. Friday session coming up. This is Bloomberg. OK, good morning. It's Friday. The karaoke trade, the karaoke crash, maybe we should call it, happened quite early in the session yesterday in the United States. This is the S&P. That's the move we saw earlier on the session. Europe's priced that because basically we went pretty flat for the rest of the session as we've come down, but there wasn't a bounce at the end of the day. There wasn't a kind of buying at the dip, and it doesn't feel like, looking at US futures this morning, that is going to be something that happens as well. CPI is coming up. So basically we've priced this. We drifted sideways yesterday, so we're kind of even Stevens with the States, though the States looks a little bit more negative this morning, Tom.
Yeah, the S&P 500 is now negative year to date, and maybe that mic drop moment from Algorithm and its logistics platform leading to that concern across that particular sector was a factor. Certainly that fed in, to your point, to the significant sell-off we saw yesterday. NASDAQ 100 closed lower by around 2%. European futures are pointing up by 0.2% after closing lower by 0.5% yesterday. FTSE 100 futures pointing gains of 34 points. We look at the banking sector with NatWest coming through with an earnings beat. Basic resources and focus as well, maybe to the downside. Iron ore under pressure in the session. DAX futures pointed to gains of 0.2%, just up 0.1%. L'Oreal over in France, Capgemini as well. Anna, Guy, what are you thinking about?
I'll have a look at some of the individual stocks because there are a few of them. A couple of them in Paris to keep an eye on then, Tom. L'Oreal is certainly one of those. The ADRs over in the States really under pressure, down 7% on the back of the numbers coming through. Concern about their sales in partly in the Asian space. That seems to be a focus of the negativity. Capgemini in focus. This could be taken pretty well by the market. They're talking about pivoting to AI and the sovereignty push helping their business. And keep an eye on tech names, ASML, for example, because Applied Materials surged 10% in late trading after delivering a surprisingly upbeat sales forecast, Guy.
OK, here we go. Friday the 13th. This is the session we're looking at. It looks fairly flat at the get-go. US futures are a little bit more negative. Big drawdown yesterday. Are we going to bounce? Are we going to buy any kind of a dip in Europe this morning? Can't see all the markets, can see some of them. FTSE 100 is up by 0.1%. The Stoxx 600 is expected to push a little bit higher. There you go. Flat. That's what we're looking at right now. So wait and see what other markets are doing. DAX and the SMI, we won't see for a moment. Tom, what do you got? Sectors.
Yeah, there's not a lot reflecting as we wait for those major indexes to open. They're up now. FTSE Mid is opening now a little flat. The IBEX over in Spain down 0.2%. Tech is your top performing sector, at least for now, having been one of the big laggards yesterday, up 1.1% on the tech sector. Financial services gaining 0.4%. Most of your sectors in negative territory. Biggest losses coming through for food and beverage right now, down 0.7%. Travel and leisure also softer by 0.6%. Four sectors, Anna, so far in positive territory. We'll see how this adjusts, but tech is up right now 1.2%. Again, Applied Materials was positive yesterday.
Yeah, absolutely. So it's that pushing up ASML up by 1.3%, but it's also the Capgemini story, and that stock is up by 3%. So we don't have the overall CAC 40, but certainly the Capgemini story will add some positivity to the French market. But having said that, we don't have an opening price on L'Oreal yet, and that one is certainly expected to go weaker given what we saw in the numbers and what we saw in the ADRs yesterday. So that one is halted, and so we'll wait to see what downside that adds to the French market. So technology is by far and away the best performing sector. There are a few others in positive territory to the downside, and it takes us to the point you were making, Guy. We've got travel and leisure, emphasis on the leisure, to the downside, because that's where you find companies like Entain, for example.
So this is DraftKings. DraftKings out with a really weak outlook yesterday. It fed through to a certain extent, but you're still seeing an impact coming through from that. That's, again, a market that has been completely disrupted at the moment, less by AI and more by the prediction market, but huge shifts underway and really hard to price. But the outlook from DraftKings really weak, and that's certainly rippling across to this side of the Atlantic.
Keep an eye on defence stocks as well, given what's happening in the Munich Security Conference. Safran is up 5.4%, so we'll keep an eye on them. Oliver Crook is on the ground for us, speaking to some of those executives in the defence space, of course. Back to the tech space, BE Semiconductor, which, of course, is over in the Netherlands as well, also up 2% on the back of the upside. The picks and shovels story, at least when it comes to Applied Materials, positive. Really interesting in terms of Applied Materials was what they had to say about memory chips and the fact that Samsung, SK Hynix, are having to build out these production facilities, which means there's more demand for Applied Materials and their kind of kit.
OK, more demand for kit. That takes us also to the ASML story, doesn't it? So let's talk about technology. Fabiana Fedeli, CIO of Equities, Multi-Asset and Sustainability at M&G Investment Management, with us on set this Friday. Morning. Good to see you, Fabiana. Help us make sense of the technology sector right now, because you've got some tech stocks doing pretty well out of the AI trade right now. Applied Materials, ASML is up this morning. Capgemini says it's pivoting to AI, and the market takes that well and in its stride. On the other hand, the market thinks it can start to pick losers from AI as well. How much clarity do you have on the way ahead here?
Good morning, Anna. So the market is clearly not ending the AI trade, but it's rethinking how it invests in AI. And it is asking all the right questions, it's not necessarily drawing the right conclusions. If you look at the three key areas of AI, the enablers, the service providers, and the beneficiaries, on the enablers side, there is clearly a lot of CapEx. Some of that will probably be misallocated. But some of that is looking at a total addressable market that we can't even think about right now, because there is so much more than AI can do. And so there is a lot of still opportunity in that area. And then there are the service providers, the software companies that obviously we've all seen crashing in their share prices. And some of them are very justified in that share price decline because their software is not strong enough. Think about companies only do user interface. But companies that have strong systems of records where clients, such as ourselves, actually trust them, entrust them with our data, and it would be a big risk for us to move that data elsewhere, those have a much stronger position.
OK, and is that how we discern the real losers from the companies that have been sold off as losers but might not be? Is it about data? Is it about those companies that hold the data? Because a couple of weeks ago when this started, one guest said it's all about the data. Those are the ones that are going to be OK.
Data, trust from your clients, the ability to work with your clients on regulatory compliance, the ability to make sure that there is safety in that data, cybersecurity, those are all key elements.
Is this moving faster than we thought it would?
This is moving faster than we thought it would maybe 2-3 years ago. But if you remember, we have been talking about the fact that the market has become so much faster. You know, whether it's technology and trading, whether it's a lot more participation by retail investors, this market is giving you much wider movements. And so the difficulty that we have is that in the past, we would think of a wide market movement as a signal. But now it could just be noise.
So what? we've gone over during this week. We've gone from worrying about commercial real estate companies. We've worried about software companies. We're worried about logistics companies. The list goes on and on and on. How do I deal with this in a portfolio? Because normally you kind of build portfolios top down and you kind of think about all the factors. But these are single stock effects, tiny companies that are upending potentially. And how do I build a portfolio that can cope with that kind of bottom-up single stock story?
You stick to fundamentals. And you said it yesterday on the program. I heard you when you said that we are all going to become stock-picking investors. Yeah. And that is what is happening.
But that's really hard.
It is hard. It is very hard. It is a more difficult market to invest in. It's a market where the big trades, the macro-driven trades, are just, especially in equities, are just not working anymore.
Maybe we've got AI to help us, Guy.
Hopefully.
Yes. It knows the answers. It can tell us who it's going to kill.
Maybe, but the history of stock picking is really difficult. And at the moment, what you've got is this kind of mechanical market that just pulls money into ETFs, like kind of month after month after month. But does that still work in a world where we're trying to pick stocks because it's a bottom-up market and that's really hard?
So we've seen two things happen. We've actually seen many of our clients saying we still keep our passive exposure, but we want to add to our active exposure.
Okay.
So we've seen that shift. And then you've seen a lot more granular ETFs, right? ETFs are not only passives. You have a lot of active ETFs coming up now. There is a lot more detail in those ETFs, and hopefully that's going to help.
So something I'm thinking about this year as well is we've got the story around Anthropic raising additional capital. Anthropic and OpenAI reported to be looking at IPOs later this year. And whether or not you get a significant rotation of capital out of some of the legacy names, the publicly listed names, into some of those. So do you want to be, there's going to be an allocation of capital into the disruptors, the Anthropics and the OpenAIs, and away from those that are going to be disrupted, where the earnings picture is just so much more challenging now. I don't know if that's a factor for you, but if it's not, where are the clearest hedges right now, Fabiana, if you want to put some ballast into that very uncertain portfolio?
So first and foremost, you said something very important. The market has been polarized on just a few names. So you should expect the market to start to broaden. And you've already seen the broadening of that trade. And it's going to be broadening in technology, but it's also going to be broadening outside of technology to companies that are benefiting from AI. If you remember, one of the best investments after the dot-com bubble was to invest in companies that benefited from the capex that had been spent by someone else. And then the ballast is still differentiation, diversification in your portfolios. And I know it sounds boring, but it has worked until now.
No, we hear that from a lot of guests as well. Do you want to diverse into Asia? How secure is the Asia trade? I mean, it's outperformed clearly significantly versus its US index on the index level, and we've seen the strength for the SK Hynix, the Samsungs and the Kospis of the world. But what are the linkages between what happens in Asia? At what point does the concerns in the US start to pull things lower in Asia as well? How secure is that moat around the Asian story?
It will be all about supply, ability to continue to deliver on that supply. It will all be about what kind of technology will take, if you want, the position of the current AI technology, which is very power intense. So at some point, something will shift in the market, but it's really too early to tell. And it looks like a lot of those companies that are still making the hardware for AI still have the ability to continue to deliver.
So it's about diversifying. Is it also a bit of a buying opportunity, Fabiana, or is that just too difficult to say at this point?
It is a very selective buying opportunity, but it is a buying opportunity. So we have been looking at companies where we thought there was a lot of strength in the IP, in the intellectual property. For example, those areas with data, with proprietary data that is entrusted by your clients. And some of those ones have been the baby that has been thrown out with the bathwater. And so, yes, we've gone back in.
Is diversifying, I just want to come back to this diversifying conversation. There seems to be this view increasingly, and I don't know whether it's real or not, that if I diversify out of the United States, what I'm diversifying into is uncorrelated from the United States. So if US indexes go down, these indexes won't go down or will go sideways. Is that true? Is that going to happen? Because if the US goes down, it feels like everything else is going to go down with it.
That is what we used to think.
Yeah.
But that is not happening now, right? We're seeing a lot of turbulence on the U.S. market, and we're seeing emerging markets outperforming.
Yeah.
Asian been very strong. It feels like the market is going back to fundamentals and is not considering anymore the U.S. as the one market and everything else as kind of the beta trade on the U.S., but it's starting to make some really clear diversification and differentiation between those ones.
On that diversification trade, what assumptions are you making about U.S. growth and whether or not the cyclical rotation has further to go?
So one of the things that we have learned over the years is that actually the equity market performance doesn't necessarily match with the GDP growth. It's more about earnings and where those earnings come from. And innovation is going to be unstoppable at this moment, and it's very, very fast. So just focus on those areas.
Okay. Very nice to see you. Thank you, Steve, for coming. A, watching yesterday, and B, coming on and pointing out what I said yesterday. Fabiana, very nice. Thank you very much indeed. Fabiana, CIO of Equities, Multi-Assets and Sustainability at M&G Investment Management. Let's take a quick look at what the Core 6 looks like this morning and figure out what is going on here, if we can. This is the picture we have at the moment. Defence stocks are on the front foot. ASML is definitely on the front foot. The hits are coming this morning from the gambling sector and also from L'Oreal, which is under significant pressure. That's not showing up here. But we'll get on to some of the other stocks that we do need to be watching because Louise Moon has all the details.
Indeed, yes, L'Oreal under a lot of pressure today, down over 6%. That's after their results this morning. A lot of weakness in spending, weakness in China, luxury really getting hit. Not just L'Oreal, but kind of across the board, but really weighing on L'Oreal stock today. That's after their fourth quarter results. Next up, we're looking at Capgemini. They will have a look at their shares up into the green. That's also after their results today. Now, results beat estimates just about, and then there's some positive comments from their CEO around AI. So AI to fuel sales going forward. Alleviating worries about a bit of disruption there from AI, so boosting their stock today. Next up, we're looking at Norsk Hydro. They will take a look at their results. Their shares down into the red, over 3%. That's after their fourth quarter. They did beat estimates, but aluminium prices are pulling back a bit today, so that's weighing on their stock. And then gambling is another key focus. That's after DraftKings results overnight in the US. A lot of softness there, and this is really impacting Flutter today, down almost 8% today for Flutter. That's after DraftKings results. A lot of worries around prediction markets potentially disrupting the space. And finally, on to Ubisoft. Now, Ubisoft shares soaring at open, up 15%, beating estimates. So great results there and being welcomed by investors.
Louise Moon, thank you very much indeed. With some of the stocks on the move this Friday morning. Coming up, we're going to be speaking to the European Commissioner for Defence and Space live from the Munich Security Conference. That is next. This is Bloomberg.
Munich Security Conference is on. Defence stocks are up. Concerns over the reliability of the US military alliance have prompted European leaders to begin unprecedented discussions about developing independent continent-wide nuclear deterrence. Leaders are gathering in the Munich Security Conference this weekend to discuss what some see as the breakdown in the post-war global order. Let's put that all together. Oliver Crook's got that job. Let's hand things over to him.
Yeah, that's right, Guy. And really, it was 12 months ago in this very hotel that we got the first dose of MAGA sort of foreign policy, what that would look like in the form of the speech of J.D. Vance. And in those 12 months, we've obviously had a litany of different things that have materialized that have drastically changed the European defense landscape. Who better to speak to about that landscape than the EU Commissioner for Defense, Andrius Kubilius. Thank you so much for joining us today here. I'm speaking here. So we sort of mark 1 year since that J.D. Vance speech. We're here expecting to hear from Marco Rubio here as well. What do you expect to hear from the United States at this Munich Security Conference?
Well, I would not be surprised if Marco Rubio will be more calm, and respectful. And we need perhaps really to see clearly some kind of different, languages, sometimes from President Trump, when something unexpected, can be announced. We are finding how to mitigate that, Mark Rutte is doing a great job here, or Alex Stubb and so on. But from another side, we need to see also very clear, deep strategic shift in American understanding of new geopolitical developments worldwide, when they are saying that they need to shift more towards Indo-Pacific to mitigate rising Chinese military powers. They need to move closer to Western Hemisphere. And they're asking us to take responsibility on conventional European defense, and this is a fair request.
And that is the one request that has been consistent. This is something that the Trump administration is very clear on. Over the last year, you've had the job of appraising where the gaps exist in European sovereign capabilities to try to shoulder more of that defense responsibility within Europe. In the last year, where do you see those gaps? Where have they closed? Where has Europe been able to close that? And where are they still problematic? And what is your focus in closing them?
Well, the biggest gap was, of course, on financial side. So we started to close that gap with all the different instruments and pledges from member states. For example, again, big achievement, historical achievement was made during NATO summit to increase defense spending up to 3.5% till 2035. That will, if to calculate that and to take into account that if all the member states will fulfill their pledges, it will bring during the next 10 years 6.8 trillion euros for defense. Also, we are very successful with safe loans. Now we are pushing forward 60 billion for Ukrainian defense. So on financial side, we are moving ahead. Definitely, very clear priority among what we need to develop is so-called priority of strategic enablers, where we are quite dependent on what Americans now are providing. And those, first of all, things are related with space possibilities, secure satellite communication, intelligence data, and that is what we also are very, very quickly are trying to ramp up and to develop our system.
And so I want to get into all of those, but I want to ask you first a very simple question that's a very difficult question. Without the U.S. support, if there were, for example, you're from Lithuania, an invasion on a Baltic nation now, would Europe be able to repel Russia?
Well, definitely we are dependent on collective defense, as Lithuania, as a Baltic state. And all European countries very much depend on collective defense. And I do not know any country which could be able to defend itself for a long period of time being alone. So definitely we want NATO to stay as a trustful and strengthened organization. And that also depends on how much we can, as Europeans, bring with development of so-called European pillar of NATO, additional strengths to NATO. From another side, we need to remember that also European Union, in its treaty, has very specific article, so-called Article 42.7, on mutual assistance in the case of war aggression, that other countries need to come with all the means which are available to help the country which is a victim of aggression, and we need to develop also that possibility.
And so thinking in ways that the EU can support that sort of that ambition to have more sovereignty and more sort of a stronger defense within Europe, the SAFE program, it was described to me by the Rheinmetall CEO as the perfect program. Those loans have begun to be dispersed. Do you think that we could get a SAFE 2 program by the end of this year? It's been very popular, certainly among defense companies.
Well, we are proud with that program. Really, it was achieved, and now it's final stages of implementation. Money will reach member states somewhere in April. So that's really effective and brings a lot of not only investments into defense production, but also solutions for structural problems. For example, a lot of contracts are done with a joint procurement, which is very important for us. I would not be surprised if we shall come with another one. As Commission President said, she has a lot of interest in having so-called SAFE 2.0. But for the time being, we are not discussing that. Now we are coming with special, really very important program on Ukraine, 60 billion for Ukrainian defense, strengthening defense preparedness, and those money also will be very important for European defense industry.
And we talk about a European NATO pillar. You also talk about a European army. Do you think, what would that sort of look like? That's not something that has gotten a lot of traction widely. And also, what do you think militarily the EU's role should be in the build-up of sort of the Arctic and defending the Arctic?
Well, I don't, I'm trying to avoid this terminology, European army, because it's a little bit misleading. With European historical, legacy European army was discussed back in 1950s. At that time it failed. But what we need to talk really again, looking into what Americans are providing us, what kind of capabilities, besides all those material ones like strategic enablers, also very important role is played by 100,000 troops, American troops, standing army, very cohesive, and which, according to experts, is playing the role of backbone military force in Europe. We need to think, if Americans really would start to diminish also that assistance, how we shall replace that. And that is where comes the question about what we call a rapid reaction force of Europeans of similar size with the same capabilities and quality. So that's what should be among our discussions, and I am simply trying to initiate, and to what I call intellectual big bang on our defense developments, because there are plenty of big issues which we need to start to discuss and to decide.
Well, thank you very much for your insight on how the Europeans are looking to deal with those issues. That's the European Defense Commissioner, Andrius Kubilius, there speaking on his expectations about what to expect here at the Munich Security Conference, potentially a more polite tone from Marco Rubio this time around.
Okay. We'll see if that tone comes through. Bloomberg's chief Europe correspondent Oliver Crook on the ground for us at the Munich Security Conference. Staying on security, the engine maker with a focus as well on defence. Safran stock is up 5.6% right now, lifting its guidance for 2026 and its outlook for 2028. JP Morgan analysts saying and reminding us that traditionally this is a business that puts out pretty conservative guidance. So it's pretty notable that they have lifted it.
The parts business is incredible. All these engine manufacturers, it's the after-sales business which is doing incredibly well. Rolls-Royce is up on the back of the same story.
Yeah.
That's what ultimately drives the margin story.
Yeah, and the more you fly, the more you service. L'Oreal, that one is a negative story this morning, down by 6%. And Tom, you were hinting at this in the break, actually, I think. But K-Beauty and C-Beauty brands, so this is Korean beauty and Chinese beauty brands, seen taking away some of the business of L'Oreal in some of those parts of Asia, which, I mean, you see that in London now. You see it in other places, not just Asia, but an interesting development.
ASML is up. That's the AMAT story. That's fairly logical. I think AMAT doing well in the States yesterday, feeding through. We're almost done. In fact, we're done. You're not.
Yes, Tom
Weekend
has to stay.
is here.
Tom has more work to do.
Should we talk about your weekend plans?
Yes, let's
curling,
do that.
lots of curling. The main one is the Calcutta Cup, obviously England versus Scotland rugby. But the Olympics are good.
4 o'clock tomorrow, approximately.
That sounds very Valentine's appropriate, all of that rugby. Excellent.
I'm sure Guy is already prepped on Valentine's Day.
I have a card ready.
I'm expecting some chocolate hearts from Guy Johnson at some point.
I put them on your desk.
Right, yes. Of course you did. Of course you did. I think we buried the lead, though, here. You know, I noticed this morning that it's not going to rain tomorrow in London.
Sunday, it's going to rain.
Yeah, I know. But if you're in London tomorrow, I think this is the big news that you need to know.
Yeah, take advantage of that. Don't be plumped in front of the TV then, watching the Winter Olympics. The scoreboard is pretty unpleasant for the UK, by the way, for Great Britain. 0-0-0-0. We have no medals.
No.
Norway's top of the list.
But doing better, perhaps, on quantum computing.
Which is coming up on Bloomberg Tech Europe. We're going to look at the ways in which quantum computing, often cited as the tech of the future, is already changing the world. Some really fascinating conversations coming up. We'll give you a deep dive on that evolving technology. Stay with us. This is Bloomberg.